Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another, deep dive. Today, we're breaking down one of the giants in the insurance world, often seen maybe as a bit unexciting, the Travelers Companies, Inc., ticker symbol TRV. On the surface, it looks like a solid, stable, maybe even boring insurance company. But the real question for us as long-term investors is this: is there more to the story? Is Travelers actually a quiet compounding machine hiding in plain sight? Or are there hidden cracks in that fortress the market might be ignoring? That's what we're here to find out.
That's a massive question. And before we really get into the weeds on Travelers, just a quick note for everyone watching or listening.
Yeah, absolutely. For those who want to act on these investing ideas or maybe just want a better platform, having a professional grade setup is, it's pretty key. We use Interactive Brokers, and we've actually partnered with them to get our viewers a stock bonus when they sign up using our link.
So they get a bonus, helps them out, and supports the channel at the same time. Win-win. That link is in the description below, right?
That's right. It's down there. And of course, if you find value in this kind of in-depth discussion, the best way to let us know, and frankly, to make sure you get the next one, it's to subscribe and like the video. It genuinely helps the channel grow. And if you have any questions about Travelers as we go, please, manifest yourself in the comment section. We do read them.
Perfect. Okay, now let's really get into it. Pillar number 1, the business model. How does this thing actually work? Tag 1, the business and its competitive fortress.
Okay, let's unpack this. At its heart, what exactly is Travelers, and how does this company, which feels like it's been around forever, actually make its money day to day? We're always looking for that simplicity, that durability, right? Something you don't need a PhD to understand.
Absolutely. And Travelers, it operates on what people often call a dual engine model. And its beauty, as you kind of hinted, is really in how straightforward it is, almost timeless. It's incredibly intelligible, which frankly is a huge plus for any long-term investor. You can actually wrap your head around where the cash comes from.
Intelligible is good, always a good sign. Okay, so tell us about these two engines. How do they, generate the profit?
So the first engine, and probably the one most folks think of immediately, is underwriting profit.
Mm-hmm.
You can sort of picture Travelers as this giant, very sophisticated risk manager. They collect premiums, that's cash paid right up front from an incredibly diverse group of customers. We're talking individuals buying auto and home insurance, stuff we all know. But critically, and this is where Travelers really shines, it also includes businesses, all sizes, needing coverage for, everything from property damage, general liability, to really specialized risks like surety bonds, complex stuff.
Right. So collecting money from, everyone, individuals, businesses. How does that actually turn into profit for Travelers, though? Where's the kind of so what for us?
The profit comes when those premiums they collect are actually greater than the total amount they eventually have to pay out in claims they call those losses, plus, all the operating expenses involved in running the business, like salaries, commissions, tech costs, all that stuff. The core goal here, the real measure of success for this engine, is something called the combined ratio.
Ah, the combined ratio. Heard that one before.
Yeah, it's key. It's simply the sum of those losses and expenses divided by the premiums they collected. And the key insight here is, if that ratio is below 100%, it means they've made an underwriting profit. They've priced the risk effectively.
Okay, so below 100% means they made money just on the insurance itself.
Exactly. That's the cornerstone of their economic strength.
Yeah.
It signals they're not just, hoping to make money on their investments down the line. They're profitable on the very act of insuring. That's huge.
So if they're good at predicting risk, setting prices, they make money right there. That's powerful. But you mentioned a second engine, arguably even more unique. What's that one?
That's investment income from float. And this is where the insurance business gets really interesting. It's a truly unique financial beast. Think about it for a second. When you pay your insurance premium today, Travelers isn't immediately paying out a claim for that specific premium. That claim might not even happen for months or years or, in some of these complex commercial lines, maybe even decades later.
Okay, so the cash just sits there.
Exactly. That cash, which technically belongs to the policyholders until a claim is paid, it sits with Travelers for potentially a very long time. This large, constantly revolving pool of capital is what the industry calls float.
And they get to invest that float. So wait, the key insight here is they're essentially getting paid through underwriting profits, ideally, to hold and invest billions of dollars that aren't actually theirs yet. That sounds incredible for a capital allocator.
Precisely. It's the magic of insurance finance, really. At the end of 2024, Travelers had an investment portfolio fueled by this float of over $94 billion.
$94 billion.
Yep.
Wow.
Mm-hmm. And they invest this capital primarily, and this is important, in a very conservatively managed portfolio, mostly high-quality fixed-income securities.
Yeah.
Bonds, basically. In fact, 98.8% of their portfolio was investment grade at the end of 2024.
It's safe stuff, mostly.
Very safe. And the income generated from this massive investment portfolio, that's a second, completely distinct stream of profit that flows directly to their bottom line. It's pure profit from investing other people's money, held temporarily. It's effectively a very low cost, or if they underwrite profitably, even a better-than-free source of capital for them.
The endurance of this model, this dual engine thing, this is where it gets really interesting for anyone thinking long-term, isn't it? Why does demand for insurance just persist year after year, decade after decade? It's not like the latest tech gadget that fades away, or will tech disrupt this too?
That's a really critical point. It's a valid question, especially today with disruption everywhere. But the thing is, the demand for insurance, it's rooted in something really fundamental, a timeless human and commercial need. The desire to mitigate risk, to achieve some financial security.
Yes.
As long as people own homes, drive cars, as long as businesses operate and face potential liabilities, that fundamental need for insurance will just be there.
It's almost foundational.
It really is. Warren Buffett himself, who, knows a thing or two about insurance.
Just a little bit.
Right. He's famously said the product will never be obsolete. In fact, its sales volume tends to increase naturally with economic growth and inflation. That creates this powerful kind of built-in secular tailwind. The world is arguably only becoming more complex, maybe more litigious, certainly facing more hazards, all of which just heightens the value proposition of having a trusted insurance partner. So yeah, disruption is a valid thought, but the underlying utility here is incredibly durable. It's highly probable this business model will be just as relevant, maybe even more so, in 20 years.
Okay, so we have these two engines working, underwriting profit, investment income from the float. But how do they interact? And what about the risks? Could these two engines, which sound so strong, actually amplify each other's weaknesses in a crisis? Could they both go wrong at the same time?
That's the crucial interplay, yeah. And it's where maybe a first-level analysis often falls short. A more sophisticated view really has to understand their symbiosis, how they work together, because that determines the long-term quality.
Yeah.
The primary risk with underwriting is, mispricing the risk or just getting hit by a massive unexpected catastrophe, a huge hurricane, wildfire, or something like that. On the investment side, the main risks are, credit defaults in their bond portfolio, or maybe adverse interest rate movements hurting bond values.
Okay.
So the key question for long-term durability is exactly what you asked. Are these risks correlated? Could they bite you at the same time? Could a financial crisis that causes bond defaults happen right when a huge catastrophe hits, creating this sort of double whammy?
And what does Travelers say about that? Do they acknowledge that potential correlation, or do they kind of brush it off?
No, they're very clear on this. Travelers Management consistently states their philosophy is that their investment portfolio is managed first and foremost to support the insurance operations. Their own words are that it's positioned to meet our obligations to policyholders under almost every foreseeable circumstance.
So paying claims comes first, investment returns second.
Absolutely. And it's not just talk. Look at the portfolio. Overwhelmingly high-quality investment-grade fixed income. This conservative approach deliberately de-risks the investment engine. It ensures their financial fortress is robust enough to pay claims, basically no matter what's happening in the markets or with catastrophes. This conservatism isn't a weakness, it's actually core strength. It embeds a margin of safety against those kinds of correlated risks hitting simultaneously. Solvency and claims-paying ability are paramount, more so than squeezing out an extra 0.1% on investments.
An intelligible business, good. But for a truly wonderful company, one that can compound wealth consistently over time, we need more. We need an economic moat, right? What protects Travelers from all the competitors? Because you look around, it feels like there are insurance companies absolutely everywhere.
You're spot on. The insurance market is incredibly crowded, incredibly fragmented. But Travelers' competitive fortress, its moat, is built on two really strong reinforcing pillars: intangible assets and scale-based cost advantages. And these aren't just, buzzwords. They represent tangible, really difficult to replicate advantages in the real world.
Okay, let's break those down. Intangible assets first. What's the main one, and why is it so hard for someone else to copy?
The primary moat, and honestly, the one that's toughest for any competitor to replicate, is their deeply embedded, data-driven underwriting culture. Management points to this again and again. It's not just a slogan on a wall. It's a real organizational capability they've refined over decades. Think about it. They have these vast stores of proprietary historical data, literally from millions and millions of policies and claims going back years. This data feeds incredibly sophisticated analytical models, allowing them to price risk with what they call granular, account-by-account precision.
Granular, so very specific.
Very specific. A smaller insurer, or maybe a newer one, simply cannot match that level of insight. They don't have the data history. This lets travelers achieve superior risk selection. They can identify and win the good business, the profitable accounts, and just as importantly, prudently avoid the bad ones, the ones likely to lose money. It's decades of learning embedded in their systems and, crucially, in their people.
So it's not just about having the data, it's the whole culture built around using it effectively. Interesting. What else falls under intangible assets? Is it just the data?
No, another powerful one is the traveler's brand itself. I mean, being a component of the Dow Jones Industrial Average, that alone signifies stability, trust, financial strength. And in insurance, those attributes are, well, they're everything. They're by far the most vital things a customer looks for. When disaster strikes, you need to know, absolutely know, that your insurer will be there, financially solid, reliable, ready to pay. That kind of trust isn't built overnight. It's earned over generations. It's a massive intangible asset.
Okay, makes sense. And the second pillar you mentioned, scale-based cost advantage. Does just being huge automatically make you better in insurance, or is it more nuanced?
That's a great question, because, yeah, size alone isn't always an advantage in every industry. But in insurance, it really can be. Travelers is one of the absolute largest P&C insurers in the U.S. We're talking over $43 billion in net written premiums. Just massive. This scale allows them to spread their substantial fixed costs, things like their enormous technology infrastructure, the corporate overhead, the very hefty regulatory compliance costs over this huge premium base. The result, a lower expense ratio compared to smaller rivals. They're just more efficient operationally.
Okay, lower cost because they're big.
Right. But here's where it gets really clever, where that symbiotic relationship comes in. This scale isn't just about being cheaper operationally. It's what funds the enormous continuous investments they make in the data and analytics capabilities that form their primary underwriting moat we just talked about.
Ah, I see. So the scale pays for the data advantage.
Exactly.
And the data advantage lets them grow profitably, select better risks, which in turn enhances their scale even further. That sounds like a powerful loop, a virtuous, self-reinforcing cycle that just keeps widening their competitive gap over time.
Precisely. That's exactly it. It creates this feedback loop that just continually widens their competitive advantage. And they're not standing still. They're continuously investing in things like AI, advanced analytics, which just further accelerate this trend. It becomes harder and harder for smaller players to even think about catching up because they just can't afford the same level of investment. And crucially, they don't have the same decades of proprietary historical data to feed the algorithms in the first place.
Okay, can you give us a concrete example of this moat actually working? Like, how does Traveler's superior insight really allow it to price risk more accurately than, say, a smaller, less sophisticated insurer? Let's take that mid-sized construction company example you brought up. How does that play out?
Okay, good example. Imagine a mid-sized construction company, maybe doing $50 million a year, looking for a general liability policy. A smaller, maybe regional insurer might price that policy based on pretty broad, generic industry data. You know, the company's revenue, number of employees, the state it operates in, basic stuff. It's kind of a blunt instrument approach.
Right, standard factors.
Exactly. Travelers, on the other hand, can leverage its massive granular historical claims database and its advanced analytical models to go much, much deeper. Their underwriters can analyze the specific safety record of that individual company over years. They can look at the exact types of projects it typically undertakes. Are they building high-rise residential towers, which have different risks than, say, single-family homes? They look at the specific litigation environment in the particular county where it does most of its work. They might even look at the claims history of its key subcontractors, if that data is available.
Wow, that's incredibly detailed. So they're looking at factors most others just couldn't even see, let alone price for.
Exactly. They're potentially evaluating dozens of variables that a smaller insurer simply doesn't have the data volume or the sophisticated analytical models to process effectively. This superior insight allows travelers to price the risk far more accurately. So maybe they could offer a more competitive premium to a low-risk, well-run contractor with a great safety record, effectively winning the best business, the cream of the crop in the market. And at the same time, they can charge a significantly higher, more appropriate premium, or maybe even just decline to quote altogether, to a high-risk contractor with a spotty safety record, prudently avoiding likely future losses.
So they cherry-pick the good risks and avoid the bad ones better than anyone else.
That's the idea. This process of superior risk selection, repeated millions of times across their incredibly diverse portfolio of risks, is the economic moat in action. It actively repels the less informed competitors and protects the long-term profitability of the whole enterprise. This is what management means when they talk about granular and deliberate execution. It's not just talk, it's built into the process.
Okay, so just to hammer this home, the moat's true durability is really cultural then, not just technological, because competitors can buy fancy software. They can get access to some third-party data feeds, right? What makes Travelers' cultural advantage so hard to actually replicate in practice?
That's a crucial distinction, absolutely, because you're right, competitors can indeed acquire sophisticated software. They can buy access to aggregated industry data. But Travelers' enduring advantage, the real secret sauce, is its culture of disciplined execution. This is what you might call a path-dependent asset. It's something built painstakingly and reinforced systematically over decades of consistent practice. It's not something you could just install like software.
How do we know it's real, though? That it's not just PR?
Well, look at the overwhelmingly positive feedback from their own employees, especially regarding their underwriting professional development program, the UPDP. It's frequently described internally and by former employees as the best training available in the industry. That strongly suggests this disciplined approach isn't accidental. It's systematically taught, ingrained, and reinforced across thousands of employees. And critically, this cultural reinforcement is also hardwired into their management incentives, which, as we'll discuss, prioritize superior returns on equity, not just, writing more premiums at any cost. So, the technology and the data, they're essential tools, yes. But the real durable moat is the organization's ingrained habit of using those tools with unwavering discipline and a relentless focus on long-term profitability. That cultural fortress is far, far harder for a competitor to assail than just the technological one.
Fascinating. Okay, now let's try and connect these ideas to the mental models used by great investors. For a financial business like insurance, what's the single biggest, most important mental model that comes to mind, the one you absolutely have to understand?
The most prominent, without any doubt, is Warren Buffett's concept of the power of float. This is the single most important mental model for truly grasping the underlying economics of a great insurance business. Buffett realized, earlier and more clearly than most, that if an insurer could consistently achieve an underwriting profit, remember, that combined ratio below 100%, they are effectively getting paid by their customers to hold and invest their money temporarily.
Okay, getting paid to hold the money.
Right. This cost-free, or even better than free float, becomes this massive, low-cost source of long-term capital. And this capital, the float, can then be invested hopefully prudently to generate a powerful second stream of profits, completely separate from the underwriting business itself.
And Travelers' strategy, their whole approach, you're saying it aligns perfectly with this Buffettian ideal. It's not just an academic concept for them.
Oh, absolutely. Their entire long-term financial strategy is basically a direct articulation of this exact model. Travelers' stated mission isn't just fluff. It's to deliver superior returns on equity. And, crucially, to generate earnings and capital substantially in excess of our growth needs. Their history of consistent underwriting profits, combined with the prudent, conservative investment of their ever-growing float, has produced this powerful and expanding stream of operating cash flow. It more than doubled, just from 2016 to 2024, hitting a record $9.1 billion in that year. This isn't just theory. This is the Buffett model of insurance excellence playing out beautifully in their actual financial results.
Okay, powerful model. Another great investor, Charlie Munger, often hammered on the importance of staying within your circle of competence. How does Travelers measure up against that principle? Do they tend to stray into areas they don't really understand, maybe chasing trends, or do they pretty much stick to their knitting?
Yeah, Munger always advised sticking rigorously to what you know and understand deeply, and actively avoiding what he famously and colorfully called diversification, expanding into unrelated or poorly understood areas just for the sake of growth. Travelers is, I think, a masterclass in applying this principle. Their growth over the years has been, as they describe it, largely organic. They focused overwhelmingly on the property and casualty insurance lines, where they have literally decades of deep experience and, crucially, that proprietary data advantage we talked about. They've largely resisted the temptation, which has frankly plagued many other financial services companies, to venture into more speculative areas or unrelated industries they don't truly understand.
Can you give a specific example of that discipline in action?
Sure. A really concrete recent example is their 2025 decision to sell off most of their Canadian P&C business for about $2.4 billion. They looked at those assets and essentially recognized that another company might be a better long-term owner for those specific lines in that specific market. But, importantly, they retained their premier Canadian surety business, a niche where they have a clear, demonstrable competitive advantage and deep expertise. This act of rational portfolio pruning, selling something off, even if it shrinks the empire slightly rather than just empire building for its own sake, is a hallmark of a management team operating squarely and intelligently within its circle of competence.
Okay, we've talked business model, we've talked Moat's mental models. Now for the scuttlebutt, as Phil Fisher called it, what do the actual customers and employees say about Travelers? Because these are the people experiencing the company firsthand, day in, day out. What does this all mean for someone trying to understand the company from the outside?
Right, the scuttlebutt. And this is where things get really interesting, because we find a very stark and I think important dichotomy. The customer feedback, frankly, presents two incredibly different pictures depending on where you look. On one hand, if you look at platforms like, say, the Better Business Bureau, customer reviews for Travelers are, well, they're overwhelmingly negative. We're talking an average rating of just 1.05 out of 5 stars. That's really low.
1.05. Ouch. That's alarming.
It is. And these reviews aren't just one-liners. They're often very detailed, quite visceral, filled with complaints specifically about the claims process. You see allegations of unfair denials, really poor communication, frustrating bureaucratic runarounds, just difficult experiences. If you looked only at that data point in isolation, it would be a massive red flag. You might just stop there.
Yeah, 1.05 on the BBB. That's visceral. It's alarming. For a lot of people, that might be an instant deal breaker. How do we, as, informed listeners trying to be rational, how do we reconcile that incredibly stark feedback with everything else we've just discussed about Travelers' apparent strengths, their stability, their brand? Is that BBB score the whole story?
It's definitely not the whole story, because broader, more systematic survey-based data paints a much, much more positive picture. For instance, a 2025 survey from Insure.com found that an impressive 90.9% of Travelers' home insurance customers actually plan to renew their policies.
90% renewal intention. That's very different.
Very different. And 84.1% said they would recommend the company to others. Similarly, NerdWallet did an analysis and found that Travelers actually received fewer than expected complaints filed with state regulators for its auto insurance business relative to its market share. Fewer than average.
Okay, so how do we possibly explain this huge gap? Are those BBB reviewers just an exceptionally vocal minority who've had genuinely awful claims experiences, maybe the worst cases? Or is there something more nuanced happening here? I mean, we've probably all had a frustrating experience with an insurance claim at some point, and those are definitely the ones we complain loudly about, right? But what about the vast majority who maybe never file a significant claim?
I think that's likely the core of it. It suggests that while the claims experience, which is, let's face it, the critical moment of truth for any insurer, can indeed be a significant point of friction, maybe even anger, for a vocal minority of customers, the overall value proposition for the much larger silent majority seems to be strong. For the vast number of policyholders who don't file a major claim in any given year, the combination of the product offerings, the pricing they get, the service from their independent agent, that whole package is apparently compelling enough to command very high levels of loyalty and renewal intentions.
So for most people, most of the time, the service is okay, maybe even good, tolerated to liked. But for those unlucky few who have a really difficult claim, it can be intensely disliked.
That seems to be the dynamic. But this dichotomy does highlight a non-trivial long-term risk, right? If these consistently negative claims experiences, amplified now by social media and review sites, start to significantly erode the fundamental trust that underpins the entire insurance enterprise, that's a key tension to watch very closely. Trust is everything here.
Okay, that makes sense. Now, what about the view from the inside, the employee perspective? Is it as conflicted as the customer feedback, or does it maybe tell a different story about the internal health and culture of the company?
Here, the contrast is really stark. The view from inside Travelers appears to be overwhelmingly positive. Employee reviews you find on platforms like Reddit, Zippia, Glassdoor, they're generally full of praise for the company's culture. the benefits package, and critically, those training programs we mentioned. That underwriting professional development program, the UPDP, is repeatedly cited as a best-in-class initiative that genuinely prepares employees for a successful career in disciplined underwriting. It builds that culture we talked about.
Any specific examples stick out?
Yeah, there was one former employee comment on Reddit that was quite striking. They said something like, "Best company ever insurance-wise. Very regretful about leaving." And mentioned how other companies would sort of hunt you down if you left Travelers, implying they were highly sought after.
Wow, high praise.
It is. And this strong internal health, this positive employee sentiment, it suggests that the operational core of the company is likely very sound. That the disciplined underwriting culture lauded by management isn't just talk, it's a tangible reality for the people working there. This gives you some confidence that they have the human capital and probably the institutional integrity to eventually address some of those customer service challenges on the claims side. It implies the core machinery is well-oiled, even if some of the customer-facing interactions definitely need improvement.
Okay, switching gears slightly. Who are Travelers' main competitors out there, and how does Travelers actually differentiate itself from them in what seems like a brutally competitive landscape? Are they just slugging it out on price, or is there something more strategic at play?
Yeah, Travelers operates in a hugely competitive, very fragmented U.S. property and casualty insurance market. Its main publicly traded competitors are giants you've definitely heard of, Allstate, Progressive, and then alongside them you have these massive mutual insurers like State Farm and the direct-to-consumer powerhouses like Geico. It's a crowded field.
And do they all kind of play the same game, use the same playbook, or do they carve out different niches, different strategies?
Not at all. Their core strategies differ pretty significantly. Progressive, for example, has really established itself as this tech and data analytics leader, largely focused on the personal auto market, selling directly to consumers online. Their whole strategy relies on massive advertising spend and incredibly sophisticated, often real-time pricing algorithms, even using telematics, tracking driving behavior.
Right, the snapshot device.
Exactly. Allstate, on the other hand, traditionally relied heavily on its vast network of captive agents, the "you're in good hands" model, primarily for personal auto and home insurance. Though it's worth noting, they're also investing very heavily now in direct-to-consumer channels and technology to compete with the Progressives and Geicos.
Okay, so Progressive is tech direct auto. Allstate is historically agents, but moving direct. Where does Travelers fit into this picture? What's their durable advantage against these massive players? What's their unique angle?
Travelers' key, and I think durable, advantage lies in its deep entrenchment, and crucially, its expertise in commercial and specialty insurance lines. This is absolutely critical to understand. While Progressive and Geico are locked in this brutal, often purely price-driven war in the increasingly commoditized personal auto space, Travelers has skillfully built a dominant position in generally less cyclical, often higher-margin niches.
Commercial and specialty. So business insurance, basically.
Business insurance, yes, but often very complex types. These are areas that are inherently more complex to underwrite, more relationship-driven than just clicking a button online for the cheapest auto quote. We're talking about things like surety bonds for construction projects, management liability insurance for corporate officers, highly tailored coverage for mid-sized businesses across a huge range of specific industries, manufacturing, healthcare, tech, you name it.
And how do they actually sell these complex products, given they're not really going direct to consumer like Progressive or Geico seem to be?
Right, this business is primarily sourced, and this is key to their model, through a very loyal, long-standing network of independent agents and brokers. These aren't captive agents selling only Travelers. They're independent advisors who work with many insurers. And these distribution partners genuinely value Travelers' deep underwriting expertise, their renowned financial stability, and the sheer breadth of their product offerings, especially when they're trying to place coverage for their valuable commercial clients. This represents a fundamentally different and, I would argue, potentially superior and more defensible business model than simply trying to be the absolute lowest cost provider of basic auto insurance.
So they win based on expertise and relationships, not just price.
Largely, yes. And interestingly, if you look at platforms like Comparably, which gather employee and customer sentiment, Travelers consistently ranks #1 against its public peers on metrics like product quality, customer service, and overall company culture. That kind of supports the idea that they compete effectively on a superior, non-price value proposition. They're really playing a different game than many of their headline competitors, and seemingly playing it very well. #Tag2. Management, stewardship, and financial resilience.
Okay, so beyond the business model itself, the People actually running the show are absolutely crucial, especially for long-term compounding. What about Travelers' leadership, particularly Alan Schnitzer, who's been CEO for a while now? What's their guiding philosophy? Do they seem like good stewards of shareholder capital?
Yeah, the analysis of Travelers' leadership, headed by Chairman and CEO Alan Schnitzer since, I believe, late 2015, reveals a team with a very clear, very rational, and distinctly owner-oriented philosophy. It strikes you as consistent and disciplined, which is exactly what you hope to see in a company you might want to own for the long haul.
What is that philosophy, though? How does he communicate it? Is it clear?
It's very clear. Mr. Schnitzer's communications, like his annual letters to shareholders, consistently articulate this disciplined, long-term approach to creating value. He's really unambiguous about it. The company's mission isn't just to be the biggest insurer out there, but to be the best. And for them, best is explicitly defined by achieving superior returns on equity over the long run. He often talks about this perform and transform agenda. Perform means executing flawlessly on the core insurance business today. Transform means investing strategically in technology, data analytics, and talent to ensure their competitive advantages, their moat, remain relevant and differentiating for the next decade and beyond.
Perform and transform. Okay.
Yeah, and his 2024 letter, for example, celebrated their record financial results not just as an achievement in itself, but as the fuel that empowers the company to fulfill its promise to customers and communities. It reflects this long-standing commitment to excellence and care. That's the language of a long-term steward, not a short-term promoter focused only on the next quarter. And importantly, Schnitzer sets a really strong ethical tone from the top. He states unequivocally things like, "Our reputation is our most valuable asset. No gain is worth sacrificing our reputation." And a business built entirely on trust, like insurance, this kind of cultural emphasis from the CEO is absolutely paramount.
Okay, the philosophy sounds great on paper, the tone seems right, but how is it actually reinforced? Does executive compensation truly align their interests with shareholders? Or are there maybe hidden incentives lurking in there that might encourage short-term thinking or excessive risk-taking?
No, the alignment looks powerfully strong here. The executive compensation structure, which they lay out in detail in their annual proxy statement, demonstrates really strong alignment with shareholder interests. For the CEO, Schnitzer, a remarkable 94% of his total compensation is performance-based, not guaranteed salary.
94%, that's high.
It's very high. And for the other top executives, the named executive officers, it's around 88%. Critically, the primary metric used for determining both their annual cash bonuses and the vesting of their long-term performance share awards is core return on equity, ROE.
ROE. Okay, why is that specific metric so important?
It's an exemplary structure because it ties the lion's share of executive pay directly to a comprehensive measure of profitability relative to the capital invested in the business. It incentivizes management to pursue genuinely profitable growth and to practice prudent capital management rather than just, chasing premium volume or market share for its own sake, which could destroy value. It directly links their personal take-home pay to how efficiently they generate profit from the shareholders' equity. That's powerful alignment.
Okay, that sounds good. Is there any weakness in this picture, though? What about direct insider ownership? You sometimes hear that low insider ownership can be a potential red flag, maybe indicating a lack of true skin in the game from the managers.
That is the one notable point that might give you pause, and it's a fair observation to make. Direct ownership of Traveler stock by the individual insiders, the executives and directors, is actually quite low. It's around 0.41% of the company's total shares outstanding. Now, executives certainly hold significant dollar amounts of stock through their compensation plans, which they often sell over time for personal financial planning, diversification, tax payments. That's pretty typical. But what you don't see are the large personal open market purchases of stock made with their own money, the kind of buying that truly signals an ultimate belief that the stock is significantly undervalued. That skin in the game signal isn't really there in a big way.
Okay, so 0.41% is low. How is that concern mitigated then? Or is it just a fundamental flaw you have to accept if you invest?
I think it's substantially mitigated, though not entirely eliminated, by management's absolutely exemplary capital allocation track record. Their actions, how they've actually deployed the company's cash over many years, have been consistently rational and shareholder-friendly. And arguably, actions speak louder than ownership percentages in many cases. Look at their strategic reinvestment. It's laser-focused on technology and analytics, specifically designed to widen their competitive moat. Their approach to mergers and acquisitions has been incredibly disciplined, favoring small, strategic bolt-on acquisitions, like buying Corvus Insurance recently to enhance their cyber capabilities, rather than splashy, expensive transformational deals. And they demonstrate a clear willingness, as we discussed, to execute large rational divestatures when it serves shareholders, like that Canadian P&C business sale.
Right. They're willing to sell off parts of the business if it makes sense for shareholders, even if it means shrinking the top line temporarily. That definitely takes discipline, resisting the empire-building urge.
Absolutely. And perhaps most importantly, Travelers is a prodigious and, I think, intelligent returner of capital to its owners. Since just 2016, they've returned over $20 billion to shareholders through a combination of dividends and share repurchases. The dividend has been increased for over 20 consecutive years now. That's a powerful testament to the business's underlying stability and cash generation. In 2024 alone, they returned $2.1 billion of excess capital, including $1.1 billion just in share repurchases. And their decision to explicitly use a significant portion of the proceeds from that Canadian sale for additional share repurchases is profoundly rational. It signals they believe the highest return investment available to them at that time was buying back their own stock. So while, yes, higher direct insider ownership would ideally be nice to see, their consistent actions demonstrate a powerful owner-like mindset and practice. The alignment feels structural and behavioral, even if the direct ownership isn't sky high.
Okay, let's shift to the financials themselves. How strong is Travelers' financial fortress? Can it genuinely withstand a major storm, both literally like a hurricane and figuratively like a deep recession? Because in insurance, that's not just rhetoric, it's a constant real-world risk they face.
Yeah, Travelers' financial history is really a portrait of remarkable stability and strength, especially when you consider they operate in the inherently volatile property and casualty insurance industry. Just look at their track record. They've achieved a double-digit core return on equity in 9 of the last 10 years. That speaks volumes about their consistent underwriting discipline and profitability. Even in 2024, which was a year marked by record catastrophe losses for the entire industry, Travelers delivered record core income of $5 billion and a core ROE of an exceptional 17.2%. That kind of performance, in a tough year, really showcases a powerful and highly resilient earnings engine that's capable of thriving even under adverse conditions.
Let's dig into some of those key financial metrics that make up what you called the Financial Fortress Scorecard. What about return on invested capital, or ROIC? Why is that an important metric for us to look at here?
ROIC is crucial because it tells you how effectively a company is using all the capital invested in its operations, both debt and equity, to generate profits. And Travelers consistently generates high returns on that capital. Their 10-year average ROIC is well into the double digits, frequently exceeding 12%, and it hit over 19% in that strong 2024 year. Morningstar calculates a normalized ROIC, smoothing things out, at around 15.6%. This level of return is significantly above their cost of capital, which is indicative of a business with a strong, durable competitive advantage in management that deploys capital efficiently. It's a key indicator of economic strength and smart management.
Okay, high ROIC, good sign. What about free cash flow, FCF conversion? That's always a critical metric people talk about because it tells us about the quality of the reported earnings. Is it real cash or just accounting?
Yeah, the quality of Travelers' earnings appears exceptionally high based on this metric. Their free cash flow conversion ratio, which is simply free cash flow divided by net income, is consistently and often significantly above 100%. Frequently, it approaches or even exceeds 200%.
Wow, 200%. So generating twice as much cash as reported profit.
In some years, yes. It means the business generates far more actual cash than its income statement reports as accounting profit. This is often due to the nature of insurance accounting and the upfront collection of premiums. It's a sign of a very healthy, highly cash-generative enterprise. It provides ample resources for those strategic investments, paying the growing dividend, and of course funding those significant share repurchases. It tells you the profits are real, tangible cash landing in the bank account, not just accounting entries.
Excellent. And finally, the balance sheet itself. Is it truly a fortress, as you said? Or could some unforeseen black swan event truly shake its foundations?
No, it absolutely looks like a fortress. They maintain a highly conservative leverage profile, which is exactly what you want to see in an insurance company that needs to withstand potential shocks. As of the end of 2024, their net debt to EBITDA ratio was very low, around 0.56 times, and their total debt to equity ratio was a modest 27.2%. This prudent, deliberate use of leverage ensures the company can withstand significant financial stress, whether that comes from a string of major catastrophic events or a severe economic downturn. without jeopardizing its solvency or its ability to pay claims. This balance sheet strength isn't just a feature, it's a core pillar of their long-term durability and their fundamental promise to policyholders. Hashtag 3, valuation, risks, and catalysts.
Okay, so we've pretty clearly established the quality of the business, the disciplined management, backed up by some really robust financials. Now, the crucial part. Let's talk about the price. How has the market historically valued Travelers? What does that valuation tell us about how it's generally perceived?
Historically, the market seems to view Travelers as a high-quality, mature, blue-chip kind of enterprise. It definitely doesn't command the sky-high multiples you might see on a speculative, high-growth tech stock, but it consistently trades at a noticeable premium compared to more troubled or maybe deeply cyclical peers within the insurance industry itself. Looking back, its price-to-earnings ratio, the PE, has generally fluctuated around a 10-year average of about 13.3 times earnings. This PE, which gives us a sense of how the market has historically valued each dollar of its earnings, has bounced around between maybe 9 times earnings during periods of market stress or deep industry pessimism, and rising up to about 18 times earnings during periods of optimism and particularly strong underwriting results.
Okay, 13x average, 9x to 18x range. What about price to book? That's often key for financials.
Right. Price to book, or PB, is crucial for financial institutions because it reflects how the market values the company's underlying balance sheet equity. For Travelers, its PB ratio is typically traded in a range of about 1.U times book value up to maybe 2.1 times book value over the past decade or so.
So, the market's view seems to consistently balance its reliable profitability and capital returns against those inherent risks of the P&C industry.
Yeah.
The catastrophes, the pricing cycles. It sees it as a quality play, but maybe not a massive growth story.
Exactly. I think the valuation reflects that balance pretty well. The market clearly acknowledges Travelers' strong fundamentals, its leadership position in key markets. But it also consistently prices in the unpredictable nature of those large catastrophic events and the inherent cyclicality of pricing and profitability within the broader insurance industry. It signals a view of Travelers as a reliable, maybe defensive compounder, but one whose reported earnings are always subject to a degree of headline risk from those unpredictable, sometimes scary events.
Okay, so given that quality is often reflected in the price, when might an opportunity arise to actually acquire shares in this wonderful company, as Buffett would say, at a truly cheap price, where you get that significant Benjamin Graham-style margin of safety? Because quality rarely goes on sale for no reason.
That's the million-dollar question, isn't it? For a business of Travelers' caliber and stability, a really significant margin of safety opportunity is unlikely to come from just gradual operational missteps or a slightly disappointing quarter. Instead, a truly compelling opportunity, a chance to buy it really cheap, would likely arise from one of two specific, more extreme scenarios. The first is simply a market-wide panic. Think about a severe bear market, maybe triggered by a recession, or a systemic financial crisis like 2008, where basically all assets, regardless of their individual quality, are indiscriminately sold off as investors just flee to the perceived safety of cash. In that kind of environment, Travelers' stock price could become temporarily, maybe significantly, disconnected from its durable, long-term intrinsic value, offering a potentially compelling entry point for those with the cash and the nerve. So essentially, wait for a broad market crash, hope it gets dragged down unfairly. What's the second scenario? Perhaps something more specific to Travelers or the insurance industry itself. The second, and maybe more likely scenario, is an industry-specific overreaction. This would typically be triggered by a year featuring one or more truly mega catastrophes. Imagine a hurricane hitting a major city on the scale of Katrina, or maybe a massive California earthquake that leads to a large, highly publicized quarterly loss for Travelers. The market, which often suffers from severe recency bias and tends to extrapolate recent negative events indefinitely into the future, might sell the stock off very aggressively based on that single bad quarter or year. A long-term investor, one who understands the company's underlying normalized earning power, its robust financial strength, and the ultimately cyclical but generally rational over time nature of the insurance market, could potentially capitalize on this short-term fear and pessimism to establish a position with a significant margin of safety. It's about seeing beyond the immediate scary headline loss to the underlying long-term earning power.
You've often said on this show that the price paid is the final and most critical hurdle, even when you're looking at a high-quality business like this one seems to be. Why is that concept so crucial here? I mean, if it's truly a wonderful company, shouldn't you just buy it whenever you have the cash, regardless of the current price?
Because the quality of the business is what provides the essential confidence to invest with a potentially multi-decade time horizon in the first place. The price you actually pay at the time of purchase is what directly determines the actual financial return you will ultimately realize on that investment over time. Think of it this way. The quality is a prerequisite. It gets the company onto your watch list. But the price paid is the final and arguably most critical hurdle to clear before pulling the trigger. For example, using those PE ratios we discussed, maybe paying 11 times earnings, which is comfortably below Traveler's historical average, provides a potential tailwind for your future returns. The valuation itself could revert higher, adding to your gains. Conversely, paying, say, 18 times earnings, near the high end of its historical range, creates a significant headwind right from the start. In that scenario, the business would have to perform exceptionally well, maybe even better than expected, and the market would need to remain optimistic about its prospects, just for you to generate even a market average rate of return. Even the greatest business on earth, bought at too high a price, can turn out to be a mediocre or even poor investment. Price matters immensely.
Okay, point taken. Let's look forward now. What are the key growth drivers for Travelers moving ahead? And perhaps even more importantly, what are the genuine long-term risks, the kind that could potentially permanently impair its value, not just cause a temporary dip? Let's start with what actually drives the growth from here.
The primary growth engine for Travelers going forward is likely to be a continuation and maybe a refinement of its existing proven strategy. It's really about continued profitable growth in net written premiums, which then gets amplified by rising net investment income from that growing float. This isn't really a story about rapid, disruptive expansion into new markets or radically new product lines. It's much more about the steady, disciplined execution of their core insurance model. What does that mean? It means achieving modest but consistent growth in premiums year after year. This comes from a combination of factors: maintaining high customer retention rates, selectively acquiring high-quality new business that meets their profitability hurdles, and implementing rational price increases across their book that hopefully outpace the underlying growth in loss costs or claims inflation.
So steady premium growth fuels the float.
Exactly. And that steady growth in the premium base directly fuels the growth of their massive investment portfolio. Now, in a structurally higher interest rate environment, which we seem to be in compared to the last decade, the income generated from that expanding portfolio should provide a significant and growing tailwind to their overall earnings. It's that dual engine model working together.
Okay, so the growth story is steady, disciplined, maybe not explosive, but potentially very reliable. Now, what about those genuine permanent impairment risks, the nightmare scenarios? What could truly derail this company in the long run, beyond just a bad year or two of catastrophes?
Yeah, the nightmare scenarios. I think there are three significant long-term threats that could potentially fundamentally damage the business or permanently impair its value. The first, and arguably the most significant and most debated, is systemic mispricing of climate risk. The absolute core of the insurance business model is using historical data patterns to predict future losses and set prices accordingly. If climate change is fundamentally shifting the frequency and severity patterns of weather-related catastrophes, more intense hurricanes, more widespread wildfires, unprecedented flooding in ways that render that historical data increasingly irrelevant for predicting the future, then the entire industry's pricing models could be fundamentally broken.
So the past is no longer a reliable guide to the future.
That's the fear. If Travelers, despite all its sophistication, consistently and materially underestimates these evolving climate-driven risks over many years, it could lead to multiple consecutive years of deeply unprofitable underwriting results that eventually erode even their substantial capital base. That's a potential existential threat.
Wow. Okay, that's a huge and incredibly complex challenge for the whole industry. What's another potential long-term impairment risk?
Second, I'd point to technological disintermediation. A significant portion of Travelers' competitive advantage, particularly in its highly profitable commercial insurance lines, is deeply intertwined with its distribution model, that network of independent agents and brokers we discussed. A truly disruptive technological innovation that successfully manages to bypass this traditional agent channel for placing complex commercial insurance products maybe imagine a highly effective AI-powered direct-to-business platform that makes the process easy and transparent for sophisticated business buyers that could severely damage Travelers' primary go-to-market strategy and erode a key part of its competitive position. If the customer relationship shifts fundamentally away from the trusted agent advisor towards a direct digital interface for complex risks, that could be a significant long-term threat.
Okay, disintermediation by tech. And finally, the third genuine risk. What else could permanently hurt them?
The third one is more internal, but potentially just as damaging: cultural decay. We spend a lot of time talking about how their most durable, hardest to replicate moat is arguably that culture of disciplined ROE-centric underwriting. It's ingrained. A change in leadership down the road, or perhaps a significant shift in the incentive structures away from this long-term discipline and towards, say, a short-sighted growth at any cost mentality, could be fatal. This would likely lead to a gradual, then perhaps rapid erosion of the company's most important intangible asset. It would manifest as poor risk selection, inadequate pricing, reserve deficiencies, and inevitably long-term financial underperformance relative to more disciplined peers. Culture is often the last thing to break in a great company, but when it does, it can be catastrophic.
Okay, those are some significant risks to keep in mind. Given those risks, what are the potential catalysts on the other side? Things that could potentially accelerate value creation or make the market pay more attention and maybe re-rate the stock higher.
Yeah, there are a couple of key potential catalysts that could unlock or accelerate value creation, maybe over the next 1 to 5 years or so. The first, and perhaps most impactful in the near term, would be a sustained, hard P&C market. The insurance market, as we know, is inherently cyclical. It goes through periods of soft pricing, lots of competition, lower premiums, and hard pricing. Less competition, higher premiums. Following periods of high industry-wide losses, often driven by major catastrophes or unexpected spikes in inflation impacting claim costs, the market tends to harden.
Meaning prices go up.
Exactly. Underwriting discipline increases across the board as insurers try to restore profitability, and premiums rise significantly, sometimes dramatically. A sustained hard market environment, perhaps driven by the recent high catastrophe costs and persistent inflation we've seen, would be a powerful catalyst for a disciplined underwriter like Travelers. It would allow them to implement significant price increases across their entire book of business, leading to potentially much wider underwriting margins and a material acceleration in their overall profit growth.
So, counterintuitively, a really difficult period of losses for the industry could actually be a really good thing for a well-run, disciplined insurer like Travelers, because it allows them to gain significant pricing power.
Interesting. What's the other potential catalyst?
The other main one would be an accelerated and expanded share repurchase program. Travelers already has a strong track record, as we discussed, of consistently returning capital to shareholders via buybacks. A catalyst would be a significant acceleration or expansion of this program beyond current expectations. This could potentially be funded by higher than expected operating cash flow generated during a prolonged hard market environment like we just discussed. Or it could be funded by proceeds from further strategic divestatures of non-core assets, similar to what they did with the Canadian sale. A large accretive share repurchase program, especially if it executed when the stock is trading at a reasonable or even undervalued level, can be an incredibly powerful driver of per-share intrinsic value growth, simply by reducing the number of shares outstanding. Fewer slices of the same profitable pie means each slice is worth more. Okay, hard market, bigger buybacks. Got it. Now, let's try to apply some second-level thinking here, go beyond the obvious. We've covered a lot of ground. What do you think the market is potentially missing about Travelers, if anything? What's the perhaps contrarian view that our deeper analysis might reveal?
Well, the market consensus view on Travelers, judging by analyst commentary and maybe its historical valuation multiples, seems to be roughly this. It's a high-quality, very stable, but ultimately pretty low-growth P&C insurer. It's often seen as a defensive, maybe even boring, blue-chip holding, but one that is perpetually exposed to that unpredictable headline risk from catastrophes and increasingly the long-term threat of climate change impacting its models. Analyst ratings often reflect this view, maybe hold or market perform, with price targets often suggesting only modest upside from current levels. Solid, reliable, but unlikely to shoot the lights out.
Okay, that sounds like a reasonable, maybe slightly cautious consensus. How does our analysis potentially challenge that? What's the deeper reality, the second-level insight that might not be fully captured in those standard consensus views?
The contrarian view, or perhaps just the deeper insight developed through this kind of detailed analysis, is that the market consensus, while probably correct on the surface facts, may be missing a more subtle, second-level reality about the company's true compounding potential. Specifically, the market appears to be focusing, maybe excessively, on the cyclical and inherently volatile nature of Travelers' reported earnings year to year. Those numbers get heavily influenced by the unpredictable timing and magnitude of catastrophe losses, creating a lot of noise. This analysis suggests the market might be significantly underappreciating the compounding power of two much more stable and arguably more predictable underlying forces.
Okay, two more stable forces being overlooked. What are they? Because that combination sounds potentially powerful if it's truly being underestimated.
The first is the consistent growth in Travelers' underlying earnings engine. If you strip out the noise of catastrophes and the effects of prior year reserve development, their underlying underwriting income has actually more than tripled over the last 8 years or so, reaching about $4.5 billion after tax in 2024. This demonstrates the powerful and remarkably consistent profitability of the core business, largely independent of that short-term catastrophe noise. The second force is the relentless, almost metronomic accretion that comes from their highly rational capital allocation machine. Specifically, the steady, tax-efficient reduction in the total share count through those disciplined buybacks we keep mentioning.
So a much more stable core profit engine than meets the eye, combined with shrinking the share count consistently.
Exactly. When you combine that fundamental strength in the underlying business with the steady reduction in the denominator, the share count, the result is a potentially powerful machine for compounding per-share intrinsic value at a much faster and more consistent rate than the volatile headline earnings per share numbers might suggest at first glance. The market sees a sturdy, maybe boring defensive utility. This deeper analysis arguably reveals a quiet, highly effective compounding machine operating beneath the surface. It's really about looking past the volatile top-line numbers to the underlying engine's health and how efficiently management is deploying the capital it generates. #TED4, Final Investment Memo Synthesis.
Okay, let's try and crystallize all of this analysis now into the core investment thesis. Boiling it down, what are the main bull and bear cases for owning Travelers stock? What are the key arguments for and against making a long-term investment here?
Okay, synthesizing it down. For the bull case, the core reasons to potentially own Travelers long-term. First, it's arguably a wonderful business. It operates an intelligible, understandable, and enduring business model serving a timeless economic need risk transfer. And it seems protected by a wide and likely widening competitive moat, built primarily on its superior, data-driven underwriting culture and significant economies of scale. Second, it appears to have excellent stewards at the helm. The company is led by a proven, seemingly owner-oriented management team. They have a stellar capital allocation track record characterized by disciplined M&A, rational divestatures, and prodigious, intelligent returns of capital to shareholders. And this is reinforced by executive compensation structures that seem tightly aligned with long-term shareholder value creation, focusing on core ROE. Third, it possesses a financial fortress. It boasts a remarkably resilient financial profile. We see consistent double-digit returns on equity, powerful and growing free cash flow generation that often far exceeds reported net income, and a conservative fortress-like balance sheet with very prudent leverage. And finally, pulling it all together, it operates as a quiet compounding machine. That powerful combination of disciplined underwriting in its core businesses, a growing investment portfolio potentially poised to benefit from higher interest rates, and that relentless capital return program through dividends and buybacks creates a highly effective, tax-efficient machine for potentially compounding per-share intrinsic value at an attractive rate over the long term, perhaps faster than the market fully appreciates.
Okay, that's a pretty compelling bull case, hitting all the key quality points: business, management, financials, compounding potential. Now, what's the other side? The bear case. The counter thesis that might give a potential investor serious pause.
Right, the counter arguments, the bear case. First, and perhaps most prominent, is the risk of unpriceable climate change. The potentially increasing frequency and severity of catastrophic weather events due to climate change represents a fundamental, difficult-to-quantify, long-term risk. This trend could, theoretically, render historical insurance pricing models obsolete, threatening the company's ability to achieve sustained underwriting profitability in the future. Second, there's clearly brand and reputation risk. That clear and persistent pattern we found of extremely poor customer reviews specifically related to claims handling poses a significant long-term threat. It could eventually erode the company's brand equity and the fundamental trust that are key intangible assets in a business built entirely on promises. Third, there's that nagging point about a lack of true skin in the game. The very low level of direct insider ownership, less than 1%, does create at least a potential, albeit somewhat mitigated by actions, misalignment of interest between management and long-term shareholders, despite the well-structured compensation plan. You'd ideally like to see more managers buying stock with their own money. And finally, there are valuation and growth constraints. As a mature leader operating in a mature industry, Travelers offers inherently limited prospects for truly high top-line revenue growth. And because the market generally recognizes its quality, the stock often trades at a valuation that reflects that quality, which can limit the opportunity to acquire shares with a substantial margin of safety, potentially capping future returns.
Okay, bull and bear cases laid out. Now, to really stress test our own thesis, let's try to actively invert the problem, as Charlie Munger always advocated. What's the most compelling, maybe even terrifying argument for why investing in travelers today could turn out to be a major long-term mistake? Let's put on the red team hat and challenge everything we just said.
Okay, the red team challenge. Let's invert. The argument would go something like this. The perceived strength of travelers' underwriting culture and its recent financial resilience. It's largely an illusion. It's mostly just the product of a recent, unusually benign cycle of catastrophe luck, combined with aggressive claims handling, and that cycle is about to end, perhaps violently. In this dark, inverted view, those thousands upon thousands of abysmal customer claims reviews on places like the BVB, they're not just anecdotal noise from a vocal minority, they are the primary and most important signal investors should be paying attention to. They reveal a corporate culture that, far from being disciplined and customer-focused, is actually deeply incentivized to boost short-term underwriting profits by systematically, maybe even unscrupulously, denying, delaying, and underpaying legitimate claims.
So the argument is the strong reported numbers are actually masking a deeper, potentially toxic internal problem related to claims.
Exactly. This practice, the red team argues, has been successful in flattering the company's reported combined ratio and ROE figures during a period of relatively normal catastrophe losses. But crucially, it has simultaneously created a vast, unquantified, hidden reservoir of brand damage and potential bad faith legal liability that could explode in the future. At the same time, the permanent and likely accelerating shift in global climate patterns has rendered the company's vaunted historical data and its sophisticated analytical models effectively obsolete. Their pricing models are fundamentally broken for the new climate reality, and they are unknowingly, or perhaps willfully blindly, writing millions of policies at premiums that do not come close to covering the true forward-looking risk of loss.
So underpriced risk combined with potentially bad claims practices. A dangerous mix.
A potentially lethal mix. The coming decade, in this nightmare scenario, will be marked by a series of massive, unexpected catastrophe losses driven by climate change, for which the company is dangerously under-reserved and significantly underpriced. When these inevitable large losses finally hit, perhaps in clusters, that toxic claims culture will be exposed on a massive scale, as potentially hundreds of thousands of customers are subjected to the same frustrating, trust-destroying experience as the current BBB reviewers. This, the red team predicts, will trigger widespread public outrage, intense regulatory scrutiny and investigations, potentially huge fines, and ultimately a catastrophic collapse in customer and agent trust and management, insulated perhaps by their low personal stock ownership, and compensated based on backward-looking ROE metrics that were artificially inflated by the old climate regime and aggressive claims tactics. They will fail to react with the necessary speed, transparency, and integrity until it's far too late. Therefore, an investment in travelers today, according to this red team challenge, would be buying a company near its peak reputation and reported profitability just before its very foundation, which is built entirely on the promise to pay claims fairly and promptly, is revealed to the world to be potentially rotten at the core.
Wow, okay, that is a powerful and frankly quite chilling counterargument. It really highlights the potential fragility that might be hidden beneath the surface, even in a company that looks so solid and stable at first glance. It just shows how much deep analysis, and considering the negative case, can reveal about a company that might seem pretty straightforward initially. We have covered an immense amount of ground today. Traveler's core dual-engine business, its powerful competitive advantages, the seemingly disciplined management team, those robust financials, and, crucially, the significant risks and potential catalysts, including that sobering red team view.
It really does highlight that intriguing, maybe uncomfortable tension, doesn't it, between the quiet compounding machine potential we identified in the bull case and that potent, plausible red team challenge.
Yeah.
It just underscores how complex, even apparently high-quality, stable businesses can be under the surface, and how essential it is to consider multiple, often conflicting perspectives before reaching any conclusions.
Absolutely. And this raises an important question for you, our listener, to ponder. How does this deep dive into travelers influence your perspective on stability and investing? Or maybe even your understanding of the underlying dynamics and risks within an industry like insurance? What stood out most to you today as the most surprising or thought-provoking insight?
And as you consider that, maybe reflect on how easy it can be for the market, and maybe for us as individual investors, to get distracted by the short-term cyclical noise, the catastrophe headlines, the quarterly earnings beats or misses, and potentially miss the more subtle underlying compounding power of a well-run business operating consistently over time. But also perhaps reflect on how even the most seemingly durable businesses, the ones with the widest moats, can face these potentially existential, slow-burn, long-term risks like climate change or cultural decay that can slowly but fundamentally shift their operating environment in ways that are hard to predict. What does that really mean for how you assess what a truly safe or low-risk investment actually is looking forward? It's not always straightforward.
Indeed. Thank you all for joining us for this deep dive into the travelers' companies. As always, keep digging, keep questioning, keep exploring those second-level thoughts. We'll see you next time on Deep Dive.